new products next by Ginnie Mae. Welcome to this week's Industry Leader Update. 2 months ago, we covered the spate of new HECM products being offered, and they gave borrowers a fixed interest rate upfront, and in many cases, a fixed rate for future withdrawals. Now, there was a rush to market by a handful of lenders to offer these fixed rate variant products, which still fell within the guidelines of the federally insured reverse mortgage or HECM program. Now, while FHA has not directly addressed these new products, Ginnie Mae has. Now, Ginnie Mae is a corporation owned wholly by the federal government within the confines of Housing and Urban Development, or HUD. The purpose of Ginnie Mae is to bring money into the housing and lending market through the issuances of mortgage-backed securities, or MBSs. These securities pool several mortgages as an asset, and they back them and they're secured by the mortgage loan performance. But then they're guaranteed by the federal government, primarily FHA, or the Federal Housing Administration Insurance Fund. Ginnie Mae's decision, at least on paper, is not so much rooted in these new products' potential risk to FHA's insurance fund, but rather the risk that servicers may be unable to honor future funds at a fixed interest rate. Put simply, interest rate risk. For example, if such a loan offers a fixed rate for initial and future funds at 5%, the servicer is obligated to honor the same fixed rate for future withdrawals. Yes, even in a higher interest rate environment. Now, Ginnie Mae fears that such loans, they could exceed the servicer's ability to meet their obligations, which requires them to maintain the financial capacity to advance funds in the future. Simply put, the agency wants any HECM loan that offers flexible payout options like 10-year payments or a line of credit to be built on an adjustable rate to compensate for future risk. Now, lenders offering these new loans must have their pool of mortgages issued as a mortgage-backed security before June 1st of this year. But beyond Ginnie Mae, what could the impact be on FHA's mortgage insurance fund, which backs HECM loans? Now, last year, HUD eliminated the standard fixed rate HECM, which did require a lump sum distribution. Borrowers secured a guaranteed interest rate, but in some cases, they drove up their loan balances unnecessarily. Now, HUD's intent was clear: to both discourage borrowers from prematurely using their proceeds and at the same time to protect FHA's insurance fund for loans whose balance may exceed the home's value upon termination in the future, and that would trigger a claim. Now, HUD's 60% first-year distribution rule sought to encourage a slower consumption of proceeds in the early years of the loan. But these recent developments point to the need for a true hybrid reverse mortgage product that offers a fixed rate for initial disbursements and a variable rate for future withdrawals. The trick is how to price such a product with investors and the secondary market. Now, what are your thoughts? Do you think that these recently eliminated products should return, or do we need a hybrid loan program? Leave your comments in the comment section below and have a great week.